Okay, testing 1, 2. Hello. See if anybody's out there. I think I did everything correctly. Had to restart my computer. It was giving me some trouble. Wasn't connecting to the web or whatever. So hopefully it's going to restart properly. Good, you guys can hear me. That's good to know. And let's see. Okay, now I gotta get this thing. It'll take me a minute to just get started though. So I gotta, all these screens are not set or anything. Thinkorswim is initializing. What is this? I don't know if it's a good time to try a new text-to-speech thing, but we'll check it out. Oh, for God's sake, really? $47. Give me a break. Oh, no, that's the one we've been using. That's no good. Huh. Can't install updates. Sorry, guys. What is this about? Windows update. This machine is screwed up. I'm gonna have to call Best Buy at this point. And I know what happened. I just don't know how to fix it. Because somehow this thing has a very small C drive and a very large D drive, and the C drive is full. And it makes it's giving it problems doing all sorts of tasks because it's out of space, but it's not really out of space. It's got like incredible amount, a huge open D drive that's just empty and nothing is recognizing it to use it. And I don't know how to make anything. I've got no idea how to make that work. Anyway. Nope, this the same problem we had last week. It just won't get to, I think Thinkorswim's incapable of running at the moment. All right, anyway, so this is running. So let me get the video going. I have to restart everything. Screen share, yes. Let me know when you guys can see something and we will do our best to get going. Let's see how this one goes.
This is a demo. Hello, I'm one of the voices you can use to speech-enable content, devices, applications, and more. When I read your text, it sounds like this.
Let's see. Oh, Bridget. I'm going to use Bridget. Let's see how she does. She's going to be slow, though. That's the only problem. So I need to do this. And I need to copy this. Can you guys see my screen? And I'm going to put that in there. And now we're going to see if it works.
Access to this webinar is for educational and
informational
purposes only. Consult a licensed
Come on, Bridget.
investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. This is
Oh, what a ripoff. She stopped. That's funny. All right, hang on a second. Oh, this is such a mess. All right, where's the one I usually use? Natural Reader. Here we go. Okay. Well, now what? Oh, play. I like the UK voice is better. Lucy, she sounds like a winner. Speed to go.
Access to this webinar is for educational and informational purposes.
Calm down.
Consult a licensed broker or registered to advise before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may occur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. Perfect timing for me to get my tea and everything. Now, we need to set up some screens. We have absolutely no information up here at all. First of all, we should look at, we don't need anything actually. We're going to talk about PSW. So let's do PhilStockWorld. I'm going to talk about the portfolio today and where we are and what's going on. Be checking on the thing. No, oh, nope, still no Thinkorswim. Oh, well, someone show that idea. It's a shame. All right, so so we need FinViz, right? That's an important one. FINVIS, FinViz. Oops, but we need the futures charts, not that one. I'm sure we'll need that one too. All right, that's true. We will need that one too. So FinViz. Do one of these say futures? Nope, just FinViz. Futures. Indexes. All right, so here we are. I've got my short in at 3,700, or I had my short in, it bounced. We should be shorting again. Oh, damn it. Freaking Thinkorswim. All right, let's give it another try. Think it's gonna work? Probably not. Oh well. All right, so futures, right? That's why I put up the futures. So yeah, we're short. I mean, you don't need me to show you. We are shorting the S&P 500 at the 3,700 line, and it's just really just short it until it breaks, short it until it doesn't work, because you don't get that badly burned. Let's take a look. So here's a 5-minute chart, okay? It's hard for it to break over 3,700, and you don't get that badly burned. It's very unlikely to just go shooting up on you. Eventually it will, but not in the first and second attempts. You're not going to likely get a big breakout. You're going to drift along that line. So when it goes over, you stop out. When it comes back under, you play it again. You have a way better chance of having a nice move down than you do having a big move against you without any support. It's highly unlikely to go through that line without backing up a little bit. Therefore, your risk is low. Here's your risk versus your reward potential, which is much higher, right? That's a good trade. That's the entire basis of trading. Go into situations where the risk is outweighed by the potential reward. Take small risks, look for big rewards. End of story. That's what these resistance lines are all about. So in energy, did the same thing at 47.50 on oil today. And that worked out early today ahead of the report. We had a nice move down. And you know, when you get a move of more than 25 cents in oil, you lock it down. I mean, that's a great move. That's $250 a contract. So we had that ahead of the report. Then we got the report. It spiked up, it spiked down, it went back. Now it's going up. Not shortable here. You have to wait for it to either cross back under 47.50 or maybe at 48, we'll try it again. But you only play it when it's crossing down. That's when you get into these things. So ahead of the report, I forget what time it was, but at some point today I said that. Long post. So there, 47. So here's where I said it's 47.50. That was 10:15, so it's right before the report. And this is why I said, well, what did I say? I said, oh, what happened to it? So I said oil is failing 747. Notice oil is failing 747.50. I don't care when it's going up. I don't care when it's gyrating around it. But when it's in the act of failing, it becomes interesting. So I said, that's a fun short, but inventories are out at 10:30, so be careful. So in other words, what I'm talking about is this. I don't know if this is not going to tell me the exact time. Is it? Oh yeah, up here. Okay, so 10:17. So we were here. So it was somewhere around here. And we were coming down. It bounced back up, came back down. You know, and if you take a stop here and lose a nickel, all right, that's $50 out of pocket. It goes back up, it comes back down, but now it fails 47.50 again. You get back in it, and now you make a quarter. That's where your risk outweighs the reward. The reward outweighs the risk. And then when it goes back up, you stop out and you're done. Then it goes back over 47.50. We're not interested in playing when it's got momentum going up, but once it's over and it comes back down, we get interested again. But now it went over and it's up and up and up. Now I say, okay, that's the end of that trade. Now we have the next line of resistance was here. Hopefully we're to 48 because it's a better line to bet on. And we'll bet that to go lower. You know, I like playing a 5-minute chart, but just give you an idea of where it is. But you can see why I like 47.50 because last time we got to 47.50 and of course it went over, but last time you got to 47.50 it was tremendous short. Got a whole $1,000 move down on here. And then it went up and tried it again, another $1,000 drop. Play those all day long, right? That's how oil tends to move. See, the 50, the 50, the 50, the 50. It tends to move between the 50-cent lines. So once you figure out where the upside of the resistance is going to be, you can play it, and you've got a nickel stop to prevent you from losing too much money against a 50-cent move down. So you got a 10-to-1 potential reward to your risk. So you only have to be right 1 out of 10 times that you play to break even. If you're right more than 1 out of 10, if you're better than 10% correct, you will make a lot of money. That's the whole point of this kind of trading, right? You don't have to be right all the time. You have to have a good discipline to prevent you from losing too much when you're wrong. You can't have an ego about it. You can't get wrapped up in the thing. You say, okay, I wasn't right that time. And that, by the way, is the same logic that ends up applying to overall trading. So in other words, here's a portfolio. This is so big. I wonder if it's so big on your screen. Control minus, I can barely see any. It's nothing on my screen. All right. So we have our long-term portfolio. Obviously, we're going to get outsized returns when the market's good in our bullish portfolio, right? I think that goes without saying. This is a bullish portfolio. We leverage our plays, and we do it all year long. So we leverage our bets, and we take positions that have tremendous payouts if they go well. In this particular year, pretty much everything went well, so we're up 150% for the year. I mean, that's a ridiculous amount of money. But there's a reason for that. It's because here's Berkshire, for example. So in March, we took a 15-month spread that goes out to June of the next year, and we spent $15,000, right? 60,000 minus 45,000, and of course we had some short puts or something else. I mean, whatever it was, it doesn't matter. The point is, but at the heart of this particular one that's left, we had a $15,000 spread, a $15,000 cost, and it's a $20 spread. So what's our upside? Our upside's 100%. And like I said, there were short puts too. Here it is. See, I told you we'd need this. All right. So, well, okay. Well, I don't have to show you a chart from March. So you know where Berkshire was in March. Where am I? Yeah, I mean, obviously Berkshire was shit in March. Oh, there you go. There's another one. We needed stock charts, right? STOCKCHARTS. All right. I am a subscriber. So in March, Berkshire was 159 or something like that. Well, that's crazy. When did we buy this thing? March 12th. So, and of course, Berkshire is going to be one of our go-tos when the market starts falling. We're going to jump right in on that. So on March 12th, which is probably somewhere around here, I was like, fine. You go below 180. I don't give a shit how low it goes after that. I'm fine buying it anywhere in this zone. So I'm not sure when March 12th was, but somewhere around here is where we bought it. Spiked down lower. Nobody cares. We sold puts, I'm sure. Then when it came back up, we bought the puts back. We already made that money. But even this trade by itself is 100% upside trade if Berkshire just goes back to, see, these got to be closer if I'm going to be doing this. There we go. So we wanted Berkshire to go back to 190. So here's Berkshire down in the 170s or wherever the hell it was in March when we did it. And we bet that it's going to get back to 190. I'm making a heroic bet. I'm betting 190, which was a previous low for a couple of years, is where it's going to come back to after 2 more years. There you go. 100% on a bull call spread, no margin required. And that one, since it's so deep in the money, we cash it out. And when did we cash it out, by the way? Last month. Last month, we did our portfolio review, and it was up here. And up here is the top of the channel. Come on, I mean, it's not hard, right? Bottom of the channel, top of the channel, buying, selling. That's all we're doing. It's not that complicated, but the complicated thing is the patience. It's waiting until it's ready to buy and waiting until it's ready to sell. And you know, this is one of the things I see with the members is there's a lot of impatience. There's a lot of people who feel like they have to trade. And you know, if you're like a lion, you spend 99% of your time not doing anything, and 1% of your time you're attacking something. That's how lions work. They don't really do anything. They sit there, and then I don't know how they have muscle tone. That's what I always wonder about. I wonder that about lions. How come they have such great muscle tone? There must be some kind of hybrid DNA thing we could do, because they never, there's no fat lions sitting around like, you know, they literally don't move all day. Lions just sit and sit and sit. Whoa, what the hell was that? Unlike the thing on my desk that just fell over. The lions just sit and sit and sit all day, and yet they have incredible musculature that just never seems to be affected by anything. It's not like they have to exercise to be that way, but when they spring to action, they can catch a gazelle. But here's my point though. They don't catch the fast gazelles, they catch the slow gazelles. They watch the ones, they look for signs of weakness very patiently. They're not just sitting, they are watching all the time. Watching, watching, watching. And when something interesting goes by, they say, ah, there's a potential snack. And they go after it. But they don't chase everything that goes by. And that's the weird thing when you watch lions. And I used to watch Wild Kingdom all the time. Speaking of things, it's a shame my kids never got to see that. I used to love that show. But you know, I used to love those nature shows. But when you observe the lions, they do nothing. They have no life. They have no interesting things to do at all. They're not like gorillas. They don't play. They don't hang out. They don't socialize. They basically just sit there all day long. Yet when and so the funny thing is though that animals can go right past them. Animals they would eat just go right past them. Nope, not in the mood, not today, not in the mood, not, you know, it doesn't matter. And you can think, well, it's a yummy antelope. It's a great, you know, so it's wonderful tasting boar. Why don't you want this thing? And it's because the lions wait patiently for the right opportunity, and then they strike. And this is what we have to learn to do as traders. You've got to learn to be patient. You've got to learn to strike when it's right to strike, and you've got to learn not to strike. And Berkshire Hathaway up here is at the top of their channel in a market environment that is clearly not justifying the top of anyone's channel. As is the S&P 500, top of the channel in a market environment doesn't justify the channel. And all these companies are like that, and that's why I'm sitting back. I am not interested in jumping into trades right now. I'm not interested in chasing stocks. This is not the right time to do it. And I know it can be kind of boring. I know it's a lot more fun to just trade stuff, but I think it's a terrible, stupid time to trade something. It's very, very dangerous. And I'm sorry, I just went through this in 2008, and I see how long it takes people to dig out of a bad situation. Why expose yourself to the possibility of getting into one? Which is why we cashed out the long-term portfolio. This portfolio right here was up 184% a month ago, and I said that's it. We're chopping these positions, and we killed Coca-Cola and the MU. And by the way, we didn't kill them because we're afraid. We killed them because Coca-Cola was up 66%. MU was up 80%. Milo, well, it wasn't up 100%. That's a mistype. but Mylan was up, whatever it was. They weren't worth keeping. Berkshire Hathaway, it's a $30,000 spread, and the net was $25,000. It's done. I gotta wait a whole another year to make that last 5,000 on 20,000, and I just showed you how easy it is to make 100% with a spread. So why would I sit on a spread? Why would I sit on $25,000 for an entire year to make 5,000 when I could just take a brand new trade, take 20,000 off the table, of which 5,000 is profit, or I'm sorry, 10,000. I'm sorry, this is a net. Man, yes, of which 5,000 profit. That's correct. It was $15,000 trade, $5,000 of profit. I could still put 5,000 back on the table into a bull call spread that's going to make 100%. And then I'll either end up making 15,000. I'll either make the $15,000 or what was I going to say? I'll either make up the extra $5,000 or I only lose 5 in its profit anyway. Can't lose. That's what you should be doing. Spend your time thinking about that rather than what's new to trade, what can I chase, what's hot, what's exciting. Sometimes nothing's exciting. Sometimes it's just not worth it. This is a market to just stay out of, basically. This is crazy. And you know it is. You know this isn't rational, what's going on right now. I think the worst thing is, though, that because of this virus and everything, it's like people have nothing else to do. So people are trading out of boredom. This Robinhood thing is crazy. The amount of people who are playing with Robinhood and trading on Robinhood because they got nothing else to do. They're just sitting at home gambling. It's all part of the problem. It's all going to crash. You know, we have a serious economic problem in this country right now, being completely ignored. We're papering it over with stimulus constantly. You can't live like that forever. It sounds like a great idea, and frankly, we've invented this whole modern monetary theory to allow for it, but that's just not the way it works. Anyway, so Berkshire we killed, Caterpillar, same thing. See, look, I mean, everybody here, 30,000 spread, it's 25,000. Forget it. We can do better with $25,000 and make 5,000 over the course of another year. PAA, that was different. We liked that one a lot. We eliminated the short puts just because it has downside risk, and so what? Broadcom, ridiculously in the money, but 95,000 out of 120. So we can leave the 95,000, make 25,000, still only 25%. May as well kill it. It's not worth keeping. I can do something else with the 95,000. So here's what we did. We're dropping, but here's 30, 30, 95. That's 155,000 right there. Cash dropping to the bottom line. Not, you know, it was already here. It was already in the profit, but we moved it from the security value to the cash. So now we have less securities that we have to protect and much more cash that we can deploy. But that still doesn't mean we have to rush in and do something with it right away. We can wait for opportunities. Like Philip Morris, I just put out a top trade alert today, which we where is it? I think we already have it in here. No, we don't. It's not in the long-term portfolio, but I'm pretty sure it's in the dividend portfolio already. So I didn't call it an official trade, but something like that. If you need a dividend play, there's a great dividend play. Very good use of money. We can go over that later. Gilead, still cheap. So meanwhile, we were shoveling money around, right? What did we do with Gilead? Gilead was down here, and it's still down here. So Gilead was down here. I think they're too cheap. They're down here because they don't have a virus cure, therefore they're not a good stock. How stupid is that? How is it necessary for Gilead to have a virus cure? So, you know, they're not one of the stocks that is catching everyone's attention at the moment. People are moving money to the big guys that have the cures and whatever. But so instead of saving money here, we took money and moved it. So we cashed these in for $960, which was $28,000, and we moved to a $50,000 spread. So we took $22,000 and invested it in Gilead down here. So now we have a very, very aggressive position in Gilead. Where was it? Oh, well, the new position's not there yet, but we have a more aggressive position in Gilead. That's right. Where is it? So now we're in the 45-65 spread. We did just have the 55 calls, but we were actually in better shape though. We bought the 55 calls for $960. Okay. And here we are cashing them out for $860. So we're cashing them out for just about what we bought them for, but now we're taking advantage of going out another year. So we lost $1. So we lost $3,000 basically on those, but we didn't really lose it because we already bought back the short calls. You know how that works. So, but of our initial investment of $960, we're at oh, I'm sorry. At the time they were $960. Oh, we're gonna roll almost to $960. I don't know why that said $860. Maybe I read it wrong at the time. Gilead. $865. Nope. So for whatever reason at the time it was I wrote the wrong number possibly. So they were $860 versus, oh, I'm sorry, there you go. That makes more sense. What do we buy them for is what's important. So I'm sorry, we bought them for $20 and we sell them for $865. We lose $35,000. So that's what we lost, not counting though the short puts, which we made money on. So let's say we lost $20,000 on that basically to start that position. So what do we do though? We're doubling down. We're spending another $22,000. And now we're in a spread, 45-65. So we spent $40,000 and we have 50 of the $20 spreads. We have $100,000 spread. So our upside is still $60,000. We spent $60,000. We had a $20,000 loss. We spent another $22,000. And now we're in this spread. So if it comes out, we're going to make our net outlay. And again, I don't know what we sold the puts for. It's just too much bother to find out right now. But it's going to be our net outlay on Gilead was $61,000. We recovered $29,000, and then we spent another. So 69 minus 25, and like I said, this let's say this is 30 that we're all in for, and then we spent 20, and it's still 100% upside. So we have a $100,000 spread now. We have 50 of the $20 spreads, but now at 65, we're going to make 150%. I'm sorry, wait. I'm sorry, we make 100%. We're going to make 100% at 65 if this gets back to 65. We only need Gilead to get there now to make 100% over the same amount of time. Although you can amortize it back, but the bottom line is over the period of from 25 until this is 2023 now, right? Nope. Yeah, 2023. So over 3 years, we're looking to make 100%, which is 30% a year. You know, plus the short puts, of course, will make some money also. So we invest when we feel it's right to invest. GM, 30 out of 35, we cashed it in. Intel, another one we added to. So Intel, this was, well, again, we've adjusted it since, obviously. We have the 45 calls in July. I'm sure we sold, I think we must have bought back some of the short somethings. I don't know what we did. Oh, all the short calls are gone. We doubled down on the short puts. That's what happened. So in January, we had Intel with the $30 puts, which is way low. We sold those. Those are on track, really. But at some point, they were bad. They got much. Here's what happened. They got much worse in January. And now let's take a look at Intel on the. So that's what happened to Intel in March. They went down to 42 bucks. Now, obviously, in January, we picked up Intel. In January, they were way the frick up here. They went plunging down to here. We sold back in January, not in January, sorry, in March. In March, we sold these way out of the money $30 puts. That was the basis of the trade, was just to sell the puts. Then in July, we added more puts, and then we added the bull call spread, and of course we bought back. Since then, we bought back the short call. So in July, we added the spread because we were very pleased with the fact that this wasn't looking in good shape. Oh, then we had this plunge. That's what happened. That's what caused us to add the spread. So we had this plunge. When we started going back up and we had the next plunge, I think we bought back the short puts, the short call, sorry. And that left us with this open spread, this aggressively open spread on Intel. I think we also doubled down. Probably, we were probably at a lower amount. So now I'm like, okay, so now Intel is down again, or it was a month ago. And I said at the time, where is it? So it had gone down, 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 and everybody's getting upset about it. And I'm just like, I said, this is about to be, and I told you so. We're going to stick with it. And that was on the 17th of November, so somewhere around 45. And I said, we're going to spend $7,000 more to roll the 50, the 2022 45s to 50 of the 35s. We rolled them down $10 and turned it into a spread again. So now at 50, we're going to get back $75,000 at 50. And how much did we spend? $7,000 here. And it's hard to tell because we don't know what the in-betweenies were. But 55 minus 20 is 25. So 25 plus 7 is $32,000, and it's a $75,000 spread. So we're back to $100,000 potential payoff, rolling and adjusting the spread. So we keep those. These are the ones we do keep, and we put more money into them. So we're not doing nothing. And that adjustment, by the way, is a brand new trade effectively, isn't it? If I'm totally buying back the position and then restarting with a new position, that's basically a new trade. So these are trade ideas that we do have and that we do put them in. It's just they come in the form of adjustments because we still like the stocks. And you can go back 10 years and look at our long-term portfolio, and probably half of the stocks in there are the same stocks. Because again, it's you don't have to have a new idea every day. Intel is worth X. IBM is worth X. US Steel is worth X. US Steel is X. X equals X. Apple is worth X. At any given time, a stock is worth something. And at any given time, if it's too cheap, you buy it. And if it's too expensive, you sell it. And this is how you make money. But it's the waiting that gets everybody confused, apparently. It's just waiting for the right time to buy a stock that's in the right place. And that goes back to, if you go to our strategy section, we talk about scaling in and out of positions. You don't know for sure that you're in the right place, so you make a smaller investment. In our case, we often will sell a put first before we do anything else. It's you make an investment, you add to it if it's going the wrong way, and you still think that it's for not a good reason. Oh, then we got the Biotech ETF. That was a pretty smart move, right? So we got LABU. LABU. I mean, how do you lose money when this is your portfolio, right? Look at that. 1264. It's 110. It's a 10 bagger this year. How's that for crazy? When did we get into that one? When did we make that call? Oh, March. Yep. You see what happened in March? We went shopping because we had cash, because we were ready, because we started a portfolio slowly in January and added positions. So March, and keep in mind, May, we weren't really recovered yet. You know, we were here, things were still cheap, so we were picking up extra things in May. But you see what most of these positions are: March, May. This is March, May. That was February early. That's why I want still in there. March. Here's more. Oh, who's this one? Intel would start in March. Labor started in March. Macy's March. Middleby March. MJ Fund, we had the puts first, but then we added the position in March. This one's May. That one's March. That was February. That was, and then we got, and that's, well, it was underperforming, but we stuck with Tanger, thank goodness, doing well. Here's a May. Here's a February. That was just regular. Well, somehow, obviously phenomenal. And then this is March, and this is March. So you get the idea. We went crazy in March, buying things. This is where we built the long-term portfolio. And of course, obviously, there's a lot of stuff that's already out of the long-term portfolio. It's like the third purge we've done this year to try to knock down our positions. So we bought like crazy when the market was cheap, and then we waited, and then when it got higher, we sold it. It's the same thing you're supposed to do all the time, except it's stretched out over 9 months. But it's the same logic. It's just an infinitely larger amount of patience that you have to do it correctly. But the problem is now we could be into another cycle that takes 3 months before we want to really start spending this cash again. That's the thing. So now we've done this, we sold these, we got out of all these positions, and we still have a third of the portfolio, but let's take a look at what's left. Now we've got the 1.4 million. We started with 500,000, so we're up 900,000, which is 180%. We have 800,000 in cash. And what's left? Well, not really any short puts. So step number one, what are we going to do? Sell short puts on things that we think are cheap at things that we would like to buy at outrageously low prices. So what are we going to do? The same thing we always do. The same way we always do it. It's just everybody's being impatient. And I don't know why, because the thing that we do works. Okay? The lion sitting around all day seems to work for him, right? when the right combination comes along, he will strike. So we got PAA, very nice dividend payer. We're happy with them, and we're getting called away. Don't forget, we got rid of the puts. That was our risky thing. We're getting called away at 5. The stock is now at well, it's 70,000, so it must be at like 9 or something like that. Oh, here it is, 1020. Well, that's our cost. I don't know what that means. So our cost was 1038 minus 2. Oh, I know, because we doubled down. We already bought back the puts. That's why. So this is a weird one, but we're going to make money as long as we get called away at 5 or more. We're going to make money. We have these open shares, and we'll be in good shape because we already adjusted this all over the place. Doesn't look good, but it really is good. Plus the dividends are huge. So we got Berkshire Hathaway left. We only got rid of one of our Berkshire Hathaway positions. We still have Berkshire Hathaway. We got China Mobile, which people are very worried about, which I'm not really worried about, but everybody insists on worrying. We have Cisco. Why are they worried? Because there's this whole rigmarole about, oh, we're going to remove these Chinese stocks, blah, blah, blah. You know why this is going on? Because so far China hasn't retaliated. China starts removing U.S. stocks and starts putting pressure on other countries not to have U.S. stocks in their exchange and things. So let's say they do it because they'll come up with reasons like we're like pollution violation, something like that. And they start excluding all the American oil companies from trading. They can put pressure on the UN to do that. And the UN, frankly, is like, screw America at this point. Because these climate accords, they're going to start doing things like that. They're going to start penalizing companies that don't follow the rules. Or China will just stop doing business with companies in America in retaliation. There's a lot of reasons it's not going to work. Also, the whole thing is stupid. It accomplishes nothing. So anyway, and of course, any rules, regulations, or accounting changes you make, China Mobile isn't going to be able to qualify. It can qualify very easily. So people have been selling them off like crazy. I'm not sure if it's still going on today or anything, but let's see. CHL. Probably stabilizing down here just a bit, like at 28.50. And we'll see what happens. But I like them long term. I think they're a bargain, but not enough so that I'm willing to jump in and spend more money. But I'm also not ready to walk out. And we only just made this adjustment to this position anyway. Cisco, got no doubts about Cisco. Foot Locker, that's I think pretty simple, staple, and look how deep in the money these are. $44, and we got a $50 call. $42, 37.50 short call. That's the same. Sorry, that's the same Gilead we just adjusted. We talked about that. Goldman Sachs, of course, obviously always makes money. 242, 210 call. IBM, do 125. They're at 125. IMAX is iffy, but they're coming back a little bit. They're all the way back to 15 now, and we had our target was 15. In fact, we're gonna get called away. That's our short call. We'll roll them probably, but that's our short call target for IMAX. That's exactly at the place we expected to be after all this hassle. Oh, we still have we have the longer June calls too. We have these short June calls we're gonna have to deal with as well. So we'll have to adjust that position. Intel, we just talked about, we added to that one. Macy's, we like them. They're back to $11. MJ is taken off, of course, with the new marijuana laws. 3M, they're over their line. Altria, we just talked about that one. I just put it out as a top trade. Oh, we did have that. Why do I think we didn't have it? So they've been in the portfolio since March. I knew we had some. And everyone is winner. They're all winners. Every single one here is a winner. Pfizer, of course, we just added recently because of the vaccine and everything. That one's already in good. Tanger Family Factory Outlet is now doing very well. SPG, Simon Properties is the mall REIT. We expect them to do a comeback, but they're already blasting up. They're at 90, and we played that again in May. So in May, they were still way down here. In fact, that's when we did buy them because they took another dip. It was one of the ones I regretted not jumping on, and then it came back down. I was like, oh, we're getting that. So when we picked them up, it was May 6th. And yeah, so sometime early in May, it was probably more like here though before it spiked down like that. But this was a good enough level for me. And we jumped all over this thing. And we picked up the spread for 56 minus 33 is what? 23 minus 15 is 8. So it's $8,000 for this spread. The 4065 spread, it's a $30,000 spread we paid $8,000 for. And all they have to do is be over 65 and we make $22,000. So basically a couple 100%. And again, it's not complicated, right? And we're already up about $32,000. So basically, this thing's about done. I mean, that's just crazy. It's like we're basically done on this trade already. And that's why we have this crazy return in the portfolio. I mean, look at these trades. Every single one a winner. And every single one 100%, 200% potential gains on the spread. That's a great year. You got to lock it down and then move on. But but I want to be clear that we could do this anytime if we're patient, just like a lion. His whole life and every other lion everywhere else in the world, they sit and they wait and they strike when the time is right. I think it's a Pink Floyd line. Yeah, you've got to strike when the moment is right without thinking. That's what they say. It's from Dogs. So you have to strike when the moment is right. You have to be ready to strike. That's what your job is, to be ready, not to trade constantly. To trade when it's the right time to trade. To sell when it's the right time to sell. That's your job, is to learn. Not to just keep trading. People think they have to practice trading. You have to practice not trading. That's the thing I think people need to understand. You have to practice not trading, put your energy towards other things. I read a lot, and I read and I read and I read, and I don't know why I'm reading all this stuff. I read, you know me, I read everything. I have varied interests. But then when there's a certain point and things sort of click, and I see something and it reminds me of another thing, that reminds me of another thing, that reminds me of another thing, and I go, there's a trend. Now I see it. And that's my strike. That's when I get up. That's when I say, hey, let's do this. So SunPower, we knew we loved them. That was an early trade. That was one of the first trades we added to the portfolio. AT&T, of course, we just basically got more bullish on them. In fact, we just added this one in September. And of course, Walgreens Boots, I've been saying for so long we're undervalued. And look how we started. We sold the puts when they crashed in March. I said, oh, WBA, let's sell the puts. Then we get the calls and we say, oh, let's buy these 50 calls. And eventually, all the way in, so in May, this is how long it takes us to make a trade, by the way. This is how we set up a trade. In March, we sell some puts. In May, we gotta go get the chart up now. So here's Walgreens. So in March, we sold some puts. In May, drop further, we bought the calls. In November, we sold some calls, and I imagine we probably sold the calls after we doubled down or something. That was November 10th. So basic, oh yeah, so here. So here, so we sell some puts, because I say I'll pay that price. And what was that price? That price was $45 minus 11, $34. So on March 2nd, I said I would be happy to pay $34 for Walgreens. I don't care what it does. I'm going to pay 34 bucks. So on March 11th, it was somewhere around here, maybe 45 bucks. And we sold the $45 puts, or whatever the hell. And anyway, so our net was 34. That's what I called a bottom. Then we do nothing. Then in May, it comes down to our bottom. So I don't bail on the puts, I add the calls. But then we waited, and it went up to here, and we didn't do anything. Then it went back down, back down, back down. Then went all the way back down here, still didn't do anything. Then down here, then all the way back down here again. And then this time when it came back up and it got back to the $45 line, that's when we say, okay, it is time to sell some covers so that we don't get burned again. Because I should have sold covers here, but I was greedy. I thought it would get to 50. I thought we'd get to the 50-day moving average or whatever that is. What is that? 40 week, oh, it's a weekly chart, so it's a 200-day. So I thought we would get to the 200-day moving average. We did not. We failed, and then we went down and down much more harshly than I thought. So I should have had a stop to sell and cover probably around 45 bucks at that point. Didn't do that. But then the next time it goes up to $45, I'm not so stupid, even though it didn't quite hit it. We said, okay, now we're going to cover because we should have sold that before. Had we sold this before, like we should have, we could have already bought them back and then resold. And that's what it's all about. It's about discipline. But the point being that you have to, you just have to have the patience to see something through. This is a trade that's been going on for 9 months. And it took us 8 months just to fill in the 3 legs of the trade. And so, you know, when you're sitting there every day saying, oh, I got to trade something, I got to move this, I got to change that. No, you don't. Okay, this portfolio made 180% doing none of that by being patient. And every year we're very patient with our long-term portfolio. And in fact, that's what I try to teach people. And I talked about this 2 years ago when we started the last long-term portfolio. I said, I want to leave this thing running. And we left it running for 2 years. But then again, it made so much money, I couldn't take it anymore. It was ridiculous. So we cashed it out last November or September, November, sometime in the fall. We cashed it out last fall. We started these portfolios like in November of last year. And again, the point was I didn't want to leave. We had $2 million of total value in the long and short-term portfolio. That was after 2 years though. Now we've got $2 million after 1 year. We're back to the same 2 million. That's how crazy this year's been. But I didn't want to risk that leaving it on the table. I don't want to risk this now, but I'm just trying to show you guys how to manage through the downturn, which hasn't come yet, but it will. Oh, is it bedtime? Oh my gosh, it's 2 o'clock already. Crazy. Let's see. Fed holds the rate unchanged. Oh, that's going to disappoint people, isn't it? What are they saying? Come on. Hang on a second. Fed.
Clarify that sort of tying this to their mandate goals that they added for the rate level last in September. The committee is also
doesn't sound good.
An economy that is slowing, and they call it a challenging time.
Challenging time.
The economy, the pandemic causing tremendous human and economic hardship.
Economy is slowing.
Before the path of the economy, they still say, depends on the
pandemic causing tremendous economic hardship.
Continue to weigh on economic activity, employment, and inflation in the near term, and poses considerable risks to the economic.
Considerable risks to the economic outlook.
The Fed has also put out its latest statement of economic projections.
I'm glad I still have those shorts.
In most areas,
you can still short the S&P at 36.95.
4% in 2020. It was 3.7% when they last forecasted in September.
They think the economy will contract by 2.4% in 2020, which is better than they thought.
3.3% in 2021 and 2.4% rather in 2023. Unemployment 6.7% rather. This year, that's down from 7.6%, falling to 3.7% by 2023. In long run, that you see the unemployment rate, and then Nehru, you might call it at 4.1%. Inflation is going to come in at 1.2% this year. Remember, they used the PCE index.
Unemployment 4.1%. Where are they getting that?
The year after, and interestingly enough, even though the Fed has said they are looking to get inflation above 2%.
Inflation's still not at their target rate. So they're basically saying they're going to just keep monetary policy really crazy easy for a very long time. Questiones, let's see. Phil, please check your MO trade. 1,000 shares, only 5 contract sale on puts and calls, math not adding up. Oh, I meant to change that to 10s. Oh, son of a bitch, really? I started with 5, and then I decided that it was silly to do 5. It was so small, and I said 10, and yep. The math is correct for 10, but I wrote 5. My bad. I changed everything but these. I forgot these guys. La, 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 la. Hey, what? Where's the freaking thing? Hang on a second, because I'm out of the computer. I never made it a top trade. How funny. It didn't go through. I don't know why. I clicked the button and then I guess I realized it was time for the webinar. I forgot about everything else. How silly. All right. Now it's there and it's officially a top trade. Refresh this and it should show up. See, there you go. All fixed. All right, thanks for pointing that out. Pfizer has pulled back significantly on a downgrade and vaccine competition. Is it time for a new entry? Given their vaccine, it seems unlikely that we will see September low, and you took advantage of the original trade. Yeah, you're not going to get there. Well, when you say it's time for a new entry, if you don't have Pfizer, then sure, I certainly still like them a lot. You know, first of all, they've already sold all the tokens they need to sell. That's number one. Number two, this was irrational, so that's not a problem. I pointed that out the other day that our Pfizer trade in the LTP is so our Pfizer trade in the long-term portfolio is this one. But okay, we did this on 9/28. So if we look at Pfizer on 9/28. Oh, excuse me. All right. So 9/28, Pfizer was drifting along, and I was really shocked that it hadn't moved. And it was 34, and now it's back to 38. It took off faster than we thought, and now it's back down. But what was our target then? Our target was on 9/28. We did the 30-37 spread. So this is our upside target. We were over that already. I mean, we went flying past it. We have no doubt that this is going to come through. Now, we picked up the spread at the time for 40 minus 23 minus 9 is 40 minus 32, $8,000 spread. Its potential to pay is 50 times 7 is $35,000. So I'm sorry, what did I say that was? 8,000, 40, 32, 8. So it's $8,000. It has a $35,000 profit potential. So $27,000 upside is like 300 and something % upside. So it's got 300% upside potential. Could almost be a trade of the year, basically. And so far, it's net 47 minus 30 is 17, minus 7 or 8 is 9. So we bought it for 8 and it's now 9. It's up $1,000. So for $9,000, still a $35,000 spread. So I would just take the same spread. You don't have to do anything different. You're $1,000 behind where we were because we timed it a little bit better. Big deal. Oh, Walgreens was just on the screen for CNBC. Oh, Bloomberg, not Bloomberg. I wonder what they did. Let's see. But yeah, again, the stupidness of the focus on the virus for Pfizer. We just did this the other day. So, I mean, I just had this conversation. Was it Monday? Oh, we talk about so many things, don't we? It's like, it's kind of crazy, isn't it? The range of topics. Oh, right there. Perfect. And you see, that's the point. This is already stuff that this is on my mind. This is what I'm reading, and I figure, like, here's what I think is important to talk about today. That's what I do. I read and I read and I read, and then when it comes time to finally get online and start talking, I'm like, okay, here's the most important thing I think is happening. And in this case, I was checking my Pfizer. They're going to get 15 billion in revenue. It's already paid for. The government already bought this stuff. 15 billion this year, 5 billion next year. This might be probably projection basically going out, but this is locked up. They've already sold all this. So it doesn't matter how many people come up with a vaccine, they're still selling that. And in fact, I believe that the government is doubling their Pfizer purchase. So it's going to be 30 billion for Pfizer. But even so, you know, Pfizer Pfizer made 16 billion last year, blah blah blah. Okay, their normal 50 billion in revenues. Normally they have 50 billion in revenue. This is a big boost. They still have the underlying 50 billion in revenues. This is just bonus. We're not playing them for the bonus. We're playing them for the normal $50 billion in revenues, and we're very happy to own these guys for that. All this virus stuff, it's nice. It's going to be good money. And you know what's going to happen? They're going to have huge income next year. This year, I mean, next year, 2021, like in a month, they're going to have huge income for 2021. Huge. Massive surge in revenues from the virus. I don't know how profitable it'll be, but they're going to have a massive surge in revenues for sure. And then in 2022, it's going to lower. There'll be less vaccines, and that'll drop off. And then people are going to sell Pfizer based on the fact that that the vaccine is no longer a thing. Because people are idiots. Whatever price it goes up to next year, they shouldn't be buying it for, and whatever price it goes down to after that, they shouldn't be selling anymore. But they're going to make that mistake in both directions on this stock because they're playing it like it's a vaccine stock. That's a vaccine stock. That's a vaccine stock. This is a major pharmaceutical. This is a major pharmaceutical. This is a major this guy, and this is a major pharmaceutical. They are not vaccine stocks. These are all steadier. But when I was looking to play the virus, I looked at J&J, AstraZeneca, and Pfizer. These guys are not at all interesting. These guys are not at all interesting. I mean, they're probably going to be great companies down the road and do great things and so on and so forth, but I'm not playing somebody who's half their business, more than half their business is based on a single event at the moment. That's not how I want to play it. I want to play it on Pfizer, who has a fabulous business and is going to be knocked up 20 to 30% based on a virus. And they got a 20% bonus revenue coming in, on top of being a great company in the first place. That's what you play. Who's Biotech? Who's CureVac? Who's Inovio? I mean, it's like you're playing these people just because some guy writes and says these people also do stuff. Somebody made a really good point, though. I think it was Farm Boy, about the company that makes the needles. Yeah, that's smart, right? There aren't that many companies making needles, and I don't think there's going to be any companies that get into the needle business based on one thing that happens. So the company that is in the needle business is going to do great. But I don't think big needle is a threat to them. So I think they're going to have a fantastic year. But after that, no. They're going to ramp up. They're going to have an incredible year, and they'll be like anybody's. Like, remember the year that this happened, and everybody whoever makes sandbags, right? When they had the New Orleans flood, those guys had a great year. Home Depot, every time there's a hurricane, they have a great time when there's a hurricane. They sell like crazy. Everybody's got to first people got to prepare for the hurricane, and then they got to fix whatever broke from the hurricane after that. And that's the greatest thing in the world for Home Depot and Lowe's. These natural disasters are fantastic. But they're cyclical. It's not the base business. So like I said, so I'll play Home Depot and Lowe's for natural disasters, but I don't want to play the sandbag company when there's a flood, because that doesn't happen that often. This virus is like a flood. It's not that often that something that bad is going to happen that's going to sustain these companies. You know, they're good to have around. You want people like that. That's frankly what capitalism is all about, is encouraging people to take advantage of things like that, so that there is a large amount of brain power and resources available in a crisis. People throw money at stuff. Investors throw money at stuff to catch these things, and that helps a lot. But it's not the be-all, end-all. So it just annoys me when people talk them up, I get annoyed. When people talk them down, I get annoyed. It's like, because the value is the value. It doesn't change. Is this a bad news is good news for stock situation? I don't think bad news is good news. I think no news matters. I don't think anything that happens really matters, or it is true. Good news is good news. Bad news is bad news. Who cares? That's what this is. Bad news doesn't matter, and good news is always good news. Oh, there's a vaccine. Fantastic. There's going to be a vaccine. Then a week later, another vaccine. It's the same freaking thing. How can you announce there's going to be a vaccine? How can you announce a vaccine breakthrough 3 times in 3 weeks from 3 different companies, and each time the stock market jumps up? As if you've cured COVID, then you've cured it again, and then you've cured it again. And we'll have another vaccine after this. It comes back again, we cured it again. It doesn't change the economy. It doesn't change the underlying health of the country, the economic health. But that's, you know, again, I'm honestly, I'm not in the mood. I don't even want to look at the virus statistics. I mean, it's just, you know, it's still raging on. Well, you got to look at it. See, that's the problem. I can't ignore it. I wish I could ignore it. I mean, how do you ignore it? It's like it's reality. I don't know. I'm really torn. I don't like talking about it all the time. But I mean, how could you possibly talk about the world situation and not talk about this? So thankfully, we don't even know what last year's numbers were anymore. I do know we were like at 16 million last week, and now we're at 17 million. So yeah, it's that many every day. 305,000. We passed 300,000 deaths. Nobody cares. Nobody cares. Brazil has gotten themselves more under control than we have. India has gotten themselves more under control than we have. We have done nothing to stop this thing at all. And now it's going to be Christmas, and they talk. I think I sent you guys that article today. The thing you can do. That's true. If you've ever had some value out of a subscription at PhilStockWorld, here's some value. The worst thing you can possibly do is gather with your family indoors in the winter in dry air with a virus. There's not a worse thing. That's why we're having such a big blowback from Thanksgiving, and these health officials are freaking out that people are going to do this again in Christmas, and people are going to have holiday parties. That moron Pompeo threw a holiday party. Nobody came. At least nobody came. He invited 300 people to an indoor holiday party, and basically nobody showed up. Look at this. Santa tests positive for coronavirus after a photo session with 50 children. Oh, what are the odds? You know what the odds are? You know, people, oh, what are the odds, man? Here's the odds. You have a human being in a country of 300 million people. So let's do some math here. Oh, where's my calculator? That's not a calculator. That's not a calculator either. Don't I have a calculator? You bastards took my calculator. Okay. So what are the odds? Well, we have 300 million people in America. We divide that by 16.7 million people. Wait, that wasn't divided. 300 divided by 16.7 is 1 in 17. But really, I think we determined that only about 9 million are currently infected. Only 9 million are currently infected. So really, let's say 300 million divided by 9 million is 1 in 33. Okay, so what are the odds, Santa? The odds are 1 in 33 that somebody you come in contact with is infected. So if you come in contact with 50 children who themselves have come in contact with 50 families, now that's different. A child is not a statistic. This is the problem people have, and that's why we have problems in the schools, which of course I predicted ages ago. But the problem with statistics is they're on the broad spectrum. Oh, I had this great conversation about that. I had a really good sexist conversation with somebody. I put this woman like in her place with statistics, but that was fun. Anyway, I'll talk about that later. Anyway, so if I remember what it was, I know it was really good argument though. Oh, women's choice. That's what it was. Not abortion choice, but women making choices. Where was it? Oh yeah. So the odds are 1 in 33 that a regular person has COVID. That's statistical across all people. That includes me, who doesn't talk. I don't go out of my house. Very sad. I hardly go out of my house. Look, I'm 57 years old. I'm overweight. I'm not taking any freaking chances. I stay home. I mostly get delivery once a week or so. I'll go out into an open air restaurant or something to just remember I'm human. I do go swimming and things like that. I go for walks sometimes, but I mean, it's really, I mostly just avoid people at in this stage. So I'm part of the count when you count how many people that would be. If you think of the average person, I'm an average person, but I'm very unlikely to be a carrier, and neither are most people my age who don't have to work. There's a big difference there too. Am I a person who has to work, or am I who has to go to an office and is forced to go somewhere to mingle with people, like do I work in restaurants or whatever, or am I a person who has the choice to work at home, therefore much less likely to be infected? Then it goes to family. My kids are off at school. I don't associate my kids. If you have young children, though, you're probably a family unit of 4 people. Those children go to school with other kids. The chance of being infected when you have school-aged children, and my niece, who's a guidance counselor at a school, she got it, her whole family got it, because as soon as she got it, everybody got it in their household. Thank God they were all fine. My nephew works at Disney, got it. He gave it to his sister and his mother. So that's two groups of my family got COVID, all thank God recovered seemingly okay, which it bodes well for my gene pool, thank goodness. So the point is that there's very different people. Santa is not having me sit on his lap. He's having children sit on his lap. Those children are much, much more likely to be exposed to COVID than we are. They're also less likely to be symptomatic than I am. Therefore, they could have it and not know it. They could be carriers and not know it. And since 1 out of 33 regular people has the virus, once you have 50 people that you come in close contact with, you have almost absolutely certainly been exposed to the virus. And then when you compound that with the fact that all of these people are children who are statistically 3 to 4 times more likely to be carrying the virus than adults, due to their contact with each other and their family unit contacts, that they all go home to houses that have 4 people in it. So they're 4 times more likely to be exposed than a shut-in like me. Okay, everything is like that. And that's why statistics are very misleading sometimes. But then you say this, what are the odds of that happening? The odds are basically 100%. There's almost no way he could have done this without being exposed to COVID. And that's crazy. So that same concept, I was talking to somebody, a woman, who about the paradox of choice. And there's the thing that, you know, in marketing, there's a paradox of choice, which is if you offer people too many choices, they can't decide, and it's ineffective. And I said to her, well, it's true, but it's not really true for men, because we were talking about something male specific, in which the marketing concept was a business thing. And we were talking about something male specific, and she was saying you can't have too many choices that people don't decide. I say, no, this is men. I said, she's like, what are you talking about? This is men. I said, it's women that can't decide. It's not men. Men love choices. Men love to read menus with 150 beers on them and pick one. Men enjoy that kind of stuff. Women freak out when when you have to choose one from column A and one from column B. They'll stare at it for like 25 minutes. That is it's a distinction between men and women. But then they do these studies and they don't make those distinctions, and they say people, this is where the paradox of choice is. So they say people only like to choose between 3 things. But that 3 things is an average. The 3 things is an average of men who are happy to choose between 10 things and women who don't like to choose anything. That's the paradox of choice, that it all gets lumped into this average where they say that 3 is the optimal amount of choices you want to offer somebody before they freak out and become inactive. But it's, you know, again, you have to dig deeper than the actual statistic and think about what makes up the statistic and how it's contrived and under what situations it's going to prove true and not true. Otherwise, the statistic is not useful. And that's a problem, because most people tend to take statistics very seriously, and they feel that it was somehow adjusted, but there's polling bias and all sorts of things that can screw up these results. So other happy news, the earth is warmer than we thought already. We're screwed. Trump, who cares? Trump, who cares? Oh my God. Do you realize that we're only a month away from not having this? That it's very possible that 1 month from now, we might be able to read like 5 news articles in a row without Trump's name coming up. All right, so there's obviously going to be side effects when you start dosing millions of people. And one of them I heard is some form of Parkinson's you can get from the virus. I don't want that. My uncle had Parkinson's. That's nasty. And again, though, it's like, okay, how many out of 1 million versus, you know, what are your chances of contracting COVID and dying? Oh, Gmail. I don't know how many of you guys got Gmail, but that's been having problems, huh? We got hacking assaults going on. The Feds, all right, so they're looking for the Feds to lower mortgage rates. They didn't do that, so I think we're going to go lower. I've already got my S&P shorts in. This is how many times, okay, who cares? Trump again, COVID again, Pompeo's party, nobody came. Aw, I had a party. I think I must have been 5. I think it was my 5th birthday party, if I can remember correctly, maybe 6. And you know, you don't remember much from that age, but it's like a vivid memory because it was March 29th, my birthday. And the thing I remember is it was snowing a lot, like a real lot, like one of the bigger snowstorms of the time. And I remember that I was staring out my window at the road, which was completely unpassable. I wasn't thinking of it that way. I was just, remember, it was just completely snowed under. And I'm staring out the window at the road, and nobody was coming to my house. It was time for my party. And so in front of me was this great big window, and I'm looking out at the road, and no cars are coming, and no people are coming. And behind me and reflected in the window was the happy birthday sign, like draped across, you know, the letters happy birthday spelled out across the thing, and the decorations and the balloons and everything else in the background. And nobody was there except for like my mom and my brother and my grandmother. So that was pretty traumatic. So I know how Mike Pompeo feels. Put it that way, because there's nothing worse than giving a party and nobody comes. That's all I remember about it. I don't know if people ended up showing up. I don't know what happened. All I know is I just remember sitting there staring out that window and being like so depressed because nobody was coming to my birthday party. All right, so Trump, blah, blah. Oh, this is crazy. The education secretary DeVos, she wants her staff to resist the Biden people when they come in. Because they're going to want to educate people. We've got to stop that. All right, so now, the Dow's down about 100 points now. Virus is raging everywhere. We already covered that topic, so let's move on. Let's go look at the Fed FOMC minutes. La 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 la. Last one of the year. Here's the statement. Oh, and materials. Oh, I love it when they have materials. That's so exciting. All right. I think Powell's going to speak soon also. So what did they say? They said nothing, basically. Oh, you know what? Let's look at a parsing of the Fed. So now we need Twitter. This is what Twitter is good for. FOMC. Yes, Fed. Fed extends temporary dollar swap lines. They continue bond buying until progress is made. Weaker demand on oil prices, holding down consumer inflation. Oh, is oil going down again? That'd be nice, except I didn't bet on it. I stopped out earlier. Here's the Fed. Who's got the little crossed out thing? That's a good picture. They're leaving all policies unchanged. Come on. Nobody's parsing it. Parsing is where they cross out the things. You know who might do that? The Wall Street Journal. All right, Fed. Watch fly. Federal Reserve. Nope, no help there. So updated plans Wednesday for purchases of government debt. Didn't change the program to provide more stimulus. New projections, which we'll take a look at. These are their materials. So GDP change. Minus 2.4%, up 4.2 next year, but that's up 4.2 from -2. So you have to net it out, and you're only netting a weak, 1.8 basically. That's a pretty weak look. Longer run 1.8. This is not good. Unemployment 6.75 next year. I knew that didn't make any sense what they were saying. Oh, Powell. How do you get up already? The Fed is strongly committed to achieving policy goals. All right. They project inflation is going to remain low for a long time, which means they're going to be actively pushing things for a long time. There's no rise in inflation that they perceive, but they could be dead wrong. The Fed funds rate not going anywhere, 0.1. And thank God, because we can't afford it. I pointed that out about the interest rates. We cannot afford normal interest rates. Look at it. Look at this longer run, 2.5. What happens when the Fed's funds rate is 2.5? Where's my calculator? So we have our $30 trillion in debt times 0.01 is $300 billion in interest. That's right where we are now. That's what we pay in interest, $300 billion a year in interest. But $30 trillion times 0.025 is 750 billion. So that's $450 billion more at some point that we're going to be paying in interest. And that's going to suck up 10% of the budget. And that's assuming that the Fed is right and they can keep rates down at 2.5. They go to 5, if they go to past 5, we have the economy is basically unsustainable. This economy cannot function if rates go to 5%. 5% would mean we're paying 1.5 trillion a year in interest on our debt. We could not possibly do that. Something would have to give. There's not 1.5 trillion you can cut from government spending. So you either have to, you either have to run up another trillion plus a year in debt just to pay your interest on your debt, which is what Japan does, or you would have to then raise taxes, which of course is never going to work. We don't see that. That seems to be not a thing that you can do in America. Powell, pandemic has left a significant imprint on inflation. Well, significant challenges, uncertainties remain with regard to timing, production, distribution of vaccines. And that's the thing also, he's recognizing that. It's the vaccine is here, but there's only 100 million doses. You need 2 shots. So that's 50 million people total can be vaccinated. And that's only 15% of the population can be vaccinated right now. The next round will allow more people to be vaccinated, but realistically, this program is going to take until June, most likely, to vaccinate the majority of the people. Ugh. So this is not going to go away quickly, and it's not going to impact quickly. And I don't see how that squares with these projections. I think they're being way too optimistic in the projections. We will have to see. Excuse me, I'm getting a phone call. I'm supposed to be on this conference call. Anyhow, all right, so wrapping things up, basically, this is not exciting at all. But let's see what the Wall Street Journal says. Fed officials realized policy predictions most of the interest rates remaining zero. They pledged in September to support the economic recovery. Fed has been buying 80 billion in treasuries and 40 million in bonds per month. Per month. Let's review the numbers here. Okay, 80. That's not 80. 80 plus 40 is 120 times 12 months. $1.4 trillion a year from the Fed to buy treasuries and mortgage bonds. That is insane. They're going to buy assets for that pace for the coming months. So that will just keep happening. A pace of $1.4 trillion annually is what they're at right now. And we are acting like everything's fine. TARP asset purchases. The United States Department of Treasury purchasing and short 700 billion of assets. Okay, this is 1.44 trillion, double. This is double TARP. So the market better be at all-time highs, because what the frick else could we possibly do? But TARP was the, was the main program. The Fed was doing some stuff too with buying assets then too. But this combination, and our government now is spending trillions, $3 trillion this year, on top of 1.4 trillion from the Fed. So that's $4.5 trillion is 1/4 of the entire economy is bailout. And we're still negative. Powell says COVID-19 case surges are very concerning, but the Dow's making a complete comeback while he's talking. Because free money, as long as we get the free money, everything's good. Fed officials didn't make those changes Wednesdays, and instead highlighted the importance. Okay, so they thought the Fed was going to do something else. Fed's done nothing else. There's no changes. It's not going to be better. We're not, and that's it. The year is over now. I mean, they're not going to make another thing. And the next meeting is going to be, when is it? Last year. Oh, here. Oh, it's already here. Is this next year? No, it's 2019. But it's late January. So that's, yeah, they meet at the end of January. So it's not that far, but it's another month away. They'll have another meeting and we'll see how things are going. He's saying he's really talking a lot about the virus case surge. So they're worried about this. They think this virus case surge is not going to be a good thing. Surprisingly, right? Because nobody seems to care otherwise. Fed policymakers been surprised late summer, early fall. Degree of economic activity is held up. They expect the economy to contract by 2.4%. I don't see where they see this growth of 4 to 5%, though. It seems like it doesn't seem likely. Emergency lending programs, blah, blah, blah. So no, that's it. There's nothing really exciting going on here. The market, as we expected, was determined to go up. We're going to get another chance to short the S&P at 3,700 right now. In fact, it's 3,705 right now. The Dow at 30,200 is also shortable. And I think that I like the S&P better, though. I just think it's a good risk reward thing. So that's where we're at. And honestly, I'm mostly inclined to wait until earnings in January, and we'll see what happens. We'll find things to buy when we have earnings reports and when companies report bad news, and we'll figure. Then it's at least we're closer to the end of the virus run, and people who look like they're going to survive 2 more quarters are going to be good. We'll see what the stimulus is. We'll have some idea of what Biden's doing, and then get the early glimpse into his State of the Union or whatever he does when he takes office. That's when we'll start developing a policy and have some clarity. And that's what I like. If I'm going to start trading, I want to have some clarity into what I'm trading into. What's the environment going to look like ahead? Powell, full economic recovery unlikely until people feel safe. Well, no kidding. So I don't know. I mean, it's right now he's giving a speech that frankly is not positive at all. They're not taking a positive policy move. Not that I think they should have, but they're not doing anything different with the policy. I told you they weren't going to do anything. Therefore, the dollar is going to get stronger. That's something we got to watch. Because the dollar, it's already happening. So the dollar, which I said would bottom out, we could have just played the dollar, right? So I said the dollar was going to bottom out at 90. I said that this morning, and the dollar bottomed out at 90, and now it's coming up because Powell is not doing the easy money thing, and therefore it's going to start putting pressure on the indexes, and they will begin to fall. It's not complicated. And on that note, I unfortunately had to go run on this conference call. But thanks everybody for coming. I appreciate it, and we'll do it again next week. All right, take care. What am I doing?